masterclass on the psychology of risk. Welcome to today's Explainer. We're charting the absolutely fascinating evolution of Jesse Livermore, and we're going to take his raw, unbelievable memoirs from reminiscences of a stock operator and transform them into a structured masterclass on the psychology of risk and the financial markets. This is all about extracting the core lessons from a guy who literally made and lost massive fortunes by learning the hard way.
Hitting 5 main chapters today: the boy plunger, beating the bucket shops, the Wall Street reality check, hustling for a bankroll, and finally, his evolution from gambler to speculator. Let's get right into it.
Chapter 1. The Boy Plunger. Our story kicks off with a teenager who couldn't care less why stocks moved. All he cared about was that his mental arithmetic could spot clear patterns in the numbers flashing on the quotation board.
His early trajectory is just incredible. Picture this. At barely 14 years old, he's posting numbers on a big board in a brokerage office. He's got this total gift for mental math, and he starts noticing that stock prices have habits. He's testing these theories out in a little notebook. Pretty soon, he pools $5 with a coworker, makes his first real trade in a bucket shop, and nets exactly $3.12 on Burlington stock. And man, it snowballs from there. By 15, he's dropping $1,000 in cold hard cash in front of his understandably freaked out mother. By 20, he's sitting on 10 grand. To put that in perspective, that was a massive fortune for a kid in the late 1800s. He got so good, local shops actually started banning him, which is exactly how he earned the nickname the Boy Plunger. Finally, at 21, practically locked out of the local game, he packs up and moves to New York with $2,500 to play in the big leagues.
Which brings us to his core early philosophy. Speculation is as old as the hills, and stock prices run on form, repeating their historical behaviors before breaking up or down. He realized super early on that human nature literally never changes. And because human nature drives the markets, well, the tape is basically just a telescope into human behavior.
Moving to Chapter 2. Beating the bucket shops. As his bankroll kept growing, Livermore hit this really unique obstacle. The very bucket shops he was trading in were actively trying to sabotage his success. They were designed to fleece the customer, not pay out massive winnings.
See, there's a razor-sharp contrast between the artificial shadow world of the bucket shop and the actual real-world stock exchange. In a bucket shop, you weren't buying real stock. You were just placing a bet on the ticker tape price, kind of like using a paper trading app today, but with real cash. Tape says 105, you get it at 105, instantly. If it ticked against your tiny margin, boom, you're wiped out automatically. But if you could read the tape like Livermore could, you could perfectly scalp a point or two because your trade had absolutely zero impact on the actual market. It was a shadow game.
But because of his freakish skill, the bucket shops didn't exactly play fair. Take this one time Livermore and a buddy were short thousands of shares of sugar stock. A major bucket shop called the Cosmopolitan realized they were about to take a huge loss. So, what do? They actually thimble-rigged the real market. They spent real money, hired a broker, and drove the actual price of sugar up to 108 on the New York Stock Exchange purely to wipe out one teenager's margins. That brief, completely artificial spike triggered the automatic limits in the bucket shop, wiping out Livermore's friend and all the other shorts. Livermore barely got out alive thanks to a gut feeling, but man, it proved that bucket shops were a completely rigged game.
All right, Chapter 3, the Wall Street reality check. Realizing he was way too successful for the bucket shops to tolerate, he makes the move to New York to trade on the actual floor. And boy, did that lead to a brutal awakening. It actually started off okay. Despite some early bumps, he caught the rhythm of the massive 1901 boom. He managed to build his initial New York stake all the way up to an unbelievable $50,000 just by trusting his tape reading and holding Northern Pacific stock during a huge rally. 50 grand for a 22-year-old in 1901, that's equivalent to over $1.5 million today. At that moment, he felt like he had totally conquered Wall Street.
But that victory was seriously short-lived. The exact bucket shop strategies that built his fortune completely betrayed him. When the massive panic of May 9, 1901 hit, trading volume just exploded. The ticker tape, the exact instrument he relied on for those split-second decisions, lagged miles behind the actual market. He's putting in market orders to sell short thinking prices are at 100, only to find out his broker actually executed him at 80. By the time he scrambled to reverse his position and buy, the market had rebounded, and he ended up buying 15 points higher than he even planned. In a single chaotic day, execution delays wiped out his entire $50,000 fortune. He was left flat broke, realizing that he'd been trying to play the real market with a bucket shop system.
Which leads us to Chapter 4, Hustling for a Bankroll. Flat broke, but knowing deep down his system was just flawed, Livermore essentially goes into financial exile. He has to rebuild his stake by going back to the very bucket shops that feared him.
And because his face and name were notorious across New England, he had to get really creative. We're talking aliases. He sneaks into bucket shops out west, once pulling $2,800 in 2 days, pretending to be some naive kid named Horace Kent. But then a St. Louis owner named Dolan spotted him as a ringer and literally threw him out. He tried another shop down the street and was recognized instantly. It was exactly like a modern casino spotting a famous card counter. He was a shark swimming in a pool of minnows, and the owners knew it.
Back in New York, things get even crazier. He discovers this network of crooked wirehouses, basically bucket shops masquerading as legitimate brokers. Knowing they were on the make, he pulls off these brilliant stings using an inactive stock. Here's how he sprung the trap. First, he'd place buy orders at 5 different wirehouses. Next, he'd rush an order to a real exchange broker to sell a chunk of the actual inactive stock. Because it was inactive, his real sale absolutely tanked the ticker price. The wirehouses, who were legally bound by the tape, were instantly forced to fill his buy orders at that rock-bottom artificially depressed price. Then he'd just quickly buy the real stock back, spike the ticker price right back up, and cash out his wirehouse trades for a massive, completely guaranteed profit.
He was relentless. He aggressively hunted down the crooked owners who had wronged him. He took Dolan in St. Louis for $2,800. He went after H.S. Teller in Hoboken, extracting over $5,100 right out of their safe in a single morning. When Teller naturally banned him, Livermore just sent in an older gentleman named McDevitt as a proxy. McDevitt traded small, built up trust, and then executed a massive short order on Livermore's command to rip out another $2,800. He literally treated these crooked shops as his personal ATMs to fund his comeback to legitimate speculation.
Okay, Chapter 5. Gambler to Speculator. Returning to New York with a fresh, fat bankroll, Livermore finally grasps the profound difference between being a tape-reading gambler and a true market speculator. He fundamentally changed his mindset. He stopped arguing with the tape. He realized that no one on earth can be 100% right all the time, and a speculator must never begin to advance until they are absolutely sure they won't have to retreat. Getting mad at the market for moving against you, it gets you absolutely nowhere. As he famously put it, there is only one side of the stock market, and it is not the bull side or the bear side, it's the right side. If you're wrong, you're wrong. The market is always right.
He finally saw that his old bucket shop, shotgun approach, scalping quick points here and there, just wasn't going to work on big game. He had to graduate from gambling to speculating. He had to look further out than just an hour ahead. We're talking studying commercial statistics, railroad earnings, and massive macroeconomic trends to capture true value. He shifted from reacting to what the tape just did to anticipating what the market was inevitably going to do based on real economic realities.
Through this whole evolution, Livermore identified this incredibly dangerous trap that catches even seasoned traders. He called it the experienced sucker. Think about it. This is the trader who read all the rules, who thinks they're being super safe and conservative by waiting for a dip to buy, and then quickly cashing out for a tiny, safe profit. Livermore learned the hard way that taking a safe 4-point profit in a raging bull market is a fatal error. I mean, how many times have you taken a tiny profit out of pure fear only to watch that asset absolutely skyrocket without you? By playing it too safe, you turn into an experienced sucker who leaves $20,000 on the table just for the comfort of securing $2,000. A true speculator catches the massive swing, not just the minor ripples.
So, as we wrap up this explainer, I really want to leave you with a provocative thought to challenge your own financial mindset. When you look at the markets, or honestly, any major trend in your industry, are you playing the big picture, anticipating inevitable shifts based on deep study?